Thanks, Eric. Excited to be back with this group and those that have listened in the past. When we originally started the macroeconomic webinar series, the sentiment was around recession and the recession watch. As weeks have progressed and many states and provinces are reopening, we begin to see recovery in the form of payroll numbers, retail sales, and more. In fact, Tim Macklin, the newly appointed governor of the Bank of Canada, said earlier this week that market conditions are normalizing. Their focus is now shifting to economic recovery. We're eager to get the point of view of those of you listening in. And so in the next 30 seconds or so, we're hopeful that you could tell us what you're thinking this recovery is going to look like. And once we've gotten a response from that, we're going to ask Dawn Desjardins to weigh in with her very informed point of view. So in the next 20 seconds now, if you could share with us what your thinking is relative to this recovery, we'd really like to hear from you. And I'll pop back here, give you another 10, and see how these results are shaping up. So it looks as though, based on the response from this group, that folks largely are seeing a W or swoosh-shaped recovery. And I think it'd be very interesting to hear from Dawn and her outlook, and maybe might change our point of view after having listened to Dawn. Dawn, over to you.
Oh, thank you, Michael. Good morning, everyone. And yes, I agree with you. Swoosh seems to be what we are anticipating in terms of our forecast as well. Now, as we know, the shock to the economy caused by COVID-19 is surpassed only by the massive damage done to the health of people across the world. We see more than 8 million people infected with the disease, and the death toll is now in the hundreds of thousands of people. But today, I want to talk about the impact on the economy of the actions that governments have had to take to combat the disease, and as well talk about the measures that likely have avoided an even worse outcome in terms of the economy. Well, when we look at the, just forwarding the slides there. Now, I'm not going to say that the current situation for the global economy isn't bad, because obviously it is. And we're expecting to see global GDP contract by a record-breaking 3% this year. The necessity of locking down large swaths of the economy has impacted all areas of our economic life. We've seen trade volumes drop, industrial production and retail sales sink, and financial market volatility soar. Now, early estimates of real GDP growth in the G20 countries in the first quarter, it shows a 17% year-over-year decline. I mean, these are numbers we never thought as economists we'd ever be talking about. And while many of the advanced economies appear to have seen the number of infections peak in the second quarter, the numbers for the emerging economies outside of China have been rising. Now, our expectation is that China's economy likely saw the sharpest decline in economic activity occur in the first quarter, but countries like the U.S., Canada, the Euro area, and the U.K. will record their largest declines in the second quarter. Now, the slowing in infections over the past couple of months has allowed these economies to start along that long process of reopening. That means we're likely to have seen the trough in economic activity in the second quarter. Now, when we think about what has been done to really try to limit the impact on the economy, or as I said earlier, really prevent an even worse outcome, we have seen governments implement extraordinary policies aimed at helping both households and businesses through the crisis. So as you can see from this chart, fiscal measures have been huge relative to the size of economies, with some countries leaning more heavily on direct support, like the U.S., with households receiving direct payments and businesses grants to pay their wage and rent bills. In countries like Canada, the support has been a little more evenly split, with some payments to households through income support for those who lost their jobs, but many of the supports to businesses coming from loan guarantees or tax deferrals. Now, central banks have been a little bit more uniform, I guess I'd say, in terms of their response. Interest rates returned or were left, as in the case of the ECB, at extraordinarily low levels. Euro area, of course, the rate is minus 50 basis points. But all other banks also lowering their policy rate. The Bank of Canada, in fact, shifted into new territory, not having had to go down the road of quantitative easing during the great financial crisis, as other central banks have had to do. The Bank of Canada now actually has gone down that road, and they are, in fact, conducting large-scale asset purchases, or QE. And these central banks, we expect, will have to maintain this elevated level of support throughout the remainder of this year, and in most cases throughout 2021. So we're expecting rates to remain low for a very long time. Well, if we look at the U.S., COVID-19 hit the U.S. economy in mid-March, resulting in a pullback in activity by both consumers and businesses. The declines in activity were even larger in April. We saw retail sales plunge. Industrial production posted a record-breaking 12% monthly decline. Perhaps better known, of course, is the impact on the labor market, 20 million jobs lost in the month of April. Now, the economy shrank by 5% at an annualized rate in the first quarter. And when we're monitoring the April data, it certainly tees up for a much bigger drop in the second quarter. 35% annualized decline we're expecting to be reported. Now, more recent data reports both on the pace of the infection, but also on the economic news, points to the U.S. economy having hit bottom in April, with May and June activity recovering, albeit not even close to pre-COVID levels. So we're expecting the U.S. economy will stage stronger gains in the second half of this year, helped by government support and very low interest rates. But even with these extraordinary supports, as you can see from the chart, we're not expecting activity to return to the pre-COVID trend pace, even as we go through 2021. Now, we are expecting the U.S. economy to expand next year by 4.8%, but again, won't be quite enough to get us back to that pre-crisis trend. Well, when we look at Canada, it's the same sort of picture, as you can see. The response to the health emergency required rapid, widespread shutdowns of large parts of the economy, in many cases all of the economy. And the services sector, of course, was facing much greater than usual pressure. The shock was exacerbated by the fact that we did see oil prices drop. And of course, for Canada, our large energy sector, even creating more disruption for the economy. Now, joblessness in Canada also increased at a record pace. There's 2.7 million fewer Canadians working as of the month of May than they were in February, before we had to put those measures into place to combat the virus. Now, the economy in Canada contracted an 8.2 annualized rate in the first quarter. And when you think about it, that's pretty staggering, considering that the economy was really only locked down for about one half of the month of March. Data for April point to a significantly bigger decline in the second quarter, and we're anticipating a 32% annualized decline, as you can see from that chart. I mean, everything else looks like a rounding error when you look at the history now, given how big these movements are in terms of the economy. And of course, in the second quarter, what we've seen is that the consumer, businesses, and trade activity across the board collapsing. Now, the better news is that the number of infections started to slow in May, and we started to see parts of the economy reopen late in that month and throughout the month of June. So to that end, we think it's quite likely the data that is being reported for April will mark the low point for our economy. And we do think that this recovery, albeit very slow, is going to gain some momentum as we go through the second half of this year. Good news, but not great. As that previous slide showed you, the depth of decline means that our economy will continue to be operating with a loss of about 5% by the end of this year compared to where we ended last year. Again, the unemployment rate is elevated. It will gradually move down as the economy reopens and starts to recover. But our forecast is that we're still going to see an unemployment rate in Canada that's going to be about 3 percentage points above December 2019's 5.6% rate. Now, one differentiating factor in this recession is that it was led by the services side of the economy, and that's atypical. Usually recessions hit, it begins with an event that damages demand for goods, and then that flows through to reduce demand for services. But not so this time, of course. The lockdown, where we had to socially distance from other people, really greater impact on the services side of our economy. So this chart just highlights how different this is. You can see that the services job losses really exceeding the goods side and much different from previous economic downturns. Now, this is, of course, important for our economy because in Canada, 70% of our GDP is generated by services side. And so we don't expect we're going to see a full recovery anytime soon. As the previous chart shows, it's probably going to take until 2022 before we're back to pre-COVID trend economic activity in Canada. Now, barring another significant wave of infections, and that is our baseline assumption, we may get smaller outbreaks, but we don't think we're going to have the degree of lockdown that we've had to have during the early phases of the crisis. We do think that we will see activity start to reemerge, but even with that, I think it's notable that when you think about it on an industry by industry basis, there are still going to be huge losses in terms of output, even as we go through this recovery phase. Agriculture, healthcare, and government services, now they're probably going to eke out gains compared to other industries, food and accommodation services, tourism, retail. We're still going to see economic losses even as we go through this opening and recovery period. And of course, low energy prices will have a huge impact on that industry and will continue to do so because even though energy prices have started to recover in recent days, they remain well below where they were in 2019. And so for the energy industry, it means that we're unlikely to see any significant increase in investment. And when we think about energy, we saw prices drop precipitously as demand was destroyed during the lockdown. And of course, supply had been picking up. Now, OPEC's agreement to cut production and the beginning of the reopening has put the energy market a little bit closer to balance. And of course, this is what we have seen recently with prices having come back. And we do think prices will remain just a little bit north of $40 on a WTI basis as we go through the remainder of this year. But that, on average, for this year will be well below what we saw in 2019 when prices were in the mid-50s. So from the perspective of Canada's reopening and recovery, expecting the energy sector to remain under pressure. Well, one thing to talk about that's always of interest, of course, is Canada's housing market. Now, the market suffered a sharp shock in terms of a decline in both March and April. And even though activity did rebound in the month of May, activity levels are still 40 to 50% below where they were in May of 2019. Now, looking forward, we do expect to see conditions remain weak. Now, for now, I think homeowners have been able to manage. Some who've lost their jobs are receiving government benefits, and most homeowners are allowed to defer their mortgage payments. So that's shoring them up at this time. But as the economy reopens, those mortgage deferrals will expire. We're probably going to see some people who have lots of jobs come back to the job market, but there will be some that will continue to face employment losses. As I say, we do think the unemployment rate will remain about 3 percentage points higher than the pre-COVID rate. And so we do think that this could create an increase in the number of properties coming onto the market, suggesting that we could see this supply pickup starting to have an impact. Demand will, we think, level off, and then you will start to see prices, which have held up reasonably well to date, start to come under downward pressure. Now, another factor for Canada's housing market is the fact that we have seen such a sharp decline in immigration. Everything is locked down, and that is very important for Canada. When we look at our population growth in 2019, 80% of that growth came from immigrants coming to Canada. The fact that we are seeing this decline during this crisis period, that means that demand for housing, which had been very strong when we had 350,000 people coming to Canada, that is going to be one of the factors that will probably see demand weaken somewhat. Now, that all sounds quite gloomy, but if we look ahead, I think there are reasons and signs to suggest that we are seeing the worst in the rearview mirror. Here we're looking at RBC's internal data, and we're monitoring here what's happening in terms of spending. And you can see that in March, it was a huge decline in terms of spending. And we started to see that pace of decline ease up a little bit as we went through the month of April. Now, official statistics were released this morning. It's quite staggering. It showed retail sales volumes falling 25% in the month of April. They gave an early read, as Statistics Canada did, for the month of May, and it did show a rebound. Although the level of sales are that would only retrace about 40%, their preliminary estimate of the March and April decline. But all to say, starting to see some easing up in that downward pressure. On the business side, the Canadian Federation of Independent Business does regularly survey its members, and the data lately shows some improvement in terms of sentiment. So again, I think all driving home that we are probably looking at the biggest declines, the trough in economic activity having occurred in April, a gradual acceleration in activity as we go through the May and June, and then a more sustained and perhaps more robust recovery as we go through the second part of this year. So we'll be thinking about the response to the crisis. We had relief offered by governments and central banks. We're now entering the reopening stage. Next will be recovery and then rebuilding. So the urgent need to provide relief from the policies and the pressure that was put on the economy because we had to put these health measures in place, we're going to see this reopening, we think, really take on some steam as we go through the months ahead. But we're then going to have to pivot. We're going to have to really see policy change to enhance and support recovery. And then eventually, we're going to need policies in place that will allow for a rebuilding of Canada's economy. So again, very much in line with people who are listening in terms of the type or the shape of the recovery that we're going to see. A long road ahead, but I think we're in the early days of recovery. So with that, I'd like to turn it back to Michael.
Don, thank you very much. I'm going to ask Eric Fu to come back here in a minute and share how you can find some of the data Don shared today in Refinitive's Icon platform. And then after Eric, we'll get to some of your questions. But in the interim, I do have another question for the group, and hoping to poll. What are the key data sets you use to validate emerging trends in the post-crisis era? And you can see that there's 5 different options there: economic data, sentiment and news, i.e. Social media sentiment, fundamentals and earnings, alternative data, alt data, or predictive models like credit risk. If you folks could provide us your thoughts on that, we'd greatly appreciate it. We'll take a quick look at your responses before we turn it over to Eric. And I would also encourage you, if you've had any questions in the course of Don's presentation or in any of what Eric shows, to certainly share those with me. So it looks as though economic data by a long shot is what most of our listeners and viewers are looking at in trying to determine and validate the emerging trends. Interesting, probably not super shocking, but appreciate everybody putting their thoughts forward. Eric, are you in a position to move forward with a demo for us?
Yeah, absolutely. Thanks, Mike. So I'm going to review Refinitive's one of our most powerful offerings, which is Datastream. So most of the content that you could actually see in Don's presentation, you could actually access with our Datastream platform. And so just a quick overview. So Datastream is actually the largest global financial time series database in the industry. It's mostly well known for its economic content sets, and it's used by several investment management firms around the world. In regards to, you can actually integrate very well with Microsoft Office. So if you want to pull the data out into Excel, do presentations with them in PowerPoint, it's very easy to do. We actually have a very powerful charting tool as well. It's called Datastream Chart Studio, offered within our Icon platform, which actually goes hand in hand with Datastream. So you can build, publish, update charts, and export directly into PowerPoint. And we're constantly expanding the data sets as well. And a good example of that is our Chinese data set that we expanded in 2019. So we're actually the largest provider of reputable Chinese economic and financial indicator data in the industry. And this is just an example of what the Datastream Navigator looks like. So going back to Don's slide 10, where we've got the central bank policy rate, you can see it's very easy to just select the detail. Oh, I think I lost my slide. There we go. So so this is basically the central bank policy rate. And you can see at the bottom of the screen, you get some pretty detailed stuff. So we've got history going back to 1992. It's updated on a monthly basis, and it comes directly from the IMF, so a very reputable source. And this is an example of our Datastream Chart Studio. So going back to slide 10 again, I was able to replicate Don's chart very easily. So you've got the historical detail all the way up to the beginning of this year, and then I was able to add in 2 forecasts very easily. And then in the top right-hand corner, you can actually see you can pull it right into Excel, PowerPoint, even Twitter or a website you might be managing. And it's very easy. Once you export it, it actually updates every time you basically open PowerPoint to do a presentation. And we're also really well known our Datastream is really well known for its unique content. It's actually used by Canada's largest public pensions and asset managers. Our international comparable economics is a very key content set. Basically looks at 157 markets around the world and standardizes 51 key indicators. So it's really easy to look at Canada versus Chinese GDP in Q1 as opposed to having to deal with standardizing the data. So our Reuters polls data is basically all history of any time aggregated economist estimates on indicators. So you can basically see through time what estimates were on certain indicators, and we track median, high, low, actual, and standard deviation values. And we've even got some more unique stuff. Our Global Entrepreneurship Monitor, which basically ranks countries around the world on how easy is it to open up a business in a country or do business in a country. And then the bottom two here, corruption percentage and country risk ratings. We basically rank countries basically on how corrupt the country is and how risky it is to do business within one of those countries. And then back to our Chinese data expansion in 2019. We are the leading database for Chinese, reputable Chinese data. We actually get sources from over 130 different economic data organizations, some that are specifically unique to Refinitiv. We've got over 350 economic series, and not just economics. We've got fixed income, commodities, treasury, indices, and fixed income indices. We've actually got a unique app with an icon as well where you can track the Belt and Road Initiative. So it's basically the largest infrastructure project ever undertaken, started by China, and now spans over 72 countries. And to kind of conclude here, so Datastream is known for its unmatched breadth and depth of data for global cross-asset analysis. So we've got over 39 million individual series, not just for economics, but spanning all across different asset classes. It's very easy to integrate directly with Microsoft Office, so you're able to pull into Excel, manipulate the data, and produce charts via PowerPoint. And we also, as of lately, it's been very, very popular that people are starting to use the Python API. So you can pull data directly into Python, and we even allow you to integrate with MATLAB and eViews. And lastly, this is just a page that shows the amount of data we have available. So again, over 39 million series, you can see at the bottom. And specific to economics, over 12 million series alone just for economics. So awesome database to review and collect any data you might want to review on economics. I'm going to pass it back to Mike now to cover the next webinar we're having, as well as go over some Q&A. Thanks.
Yeah, and thanks, Eric, very much for that. And hopefully our viewers have found that beneficial. We have got a couple of really good questions, so I think this will prompt some good dialogue, and hope Don is ready. The first comes from Chuck McAteer at Area Wealth. And Chuck's question is, how will your view of the economy change if there is a second wave, which now looks more likely? And as somebody that lives predominantly in Florida, I can tell you that that notion of the second wave seems to be hitting home with some of the pretty significant increases in cases that we're seeing down here. Don, any thoughts on that?
Yeah, I mean, it's certainly, when we think about a second wave, that requires a significant lockdown. I mean, we've seen, as you can see on those charts, just the wallop for the economy that we've experienced. Now, rates having low rates in that environment, it's not tremendously helpful if people aren't going out and doing anything and being unable to do that. So I think it does present a significant downside risk to our view. And of course, it even suggests that, how much more fiscal stimulus can we rely on? But certainly, I think what governments have shown us is that they are pulling out all the stops. So you certainly could see, more stimulus packages. That will be necessary. Really, I think it's keeping people and businesses afloat during the downturn is really what we've had to see. It's not so much stimulus, it's support. So it would have to be the case, I think, that we would see another bout of fiscal spending on the rate side. Again, central banks definitely are saying the same line. They are willing to be as active as they have to be in order to keep the economy, the financial system, lubricated and running. And so certainly I think that is another thing we will have to look forward to. So yeah, I mean, our base case, as I said, is not that we have as severe an outbreak. So our forecasts don't reflect this type of thing, but even the OECD, they have put out some forecasts, and they're dire. But if they even put in another, you just see absolutely enormous declines in economic activity. Once again, they have kind of put it in the third quarter, I believe.
Really helpful. Your comments make me reflect on, what we saw in the real estate crisis, largely 2008, 2009, and the response of the central banks. And part of me wonders if the response we're seeing today relative to COVID-19, how informed that was by the experience of 2008, 2009, and the aggressive actions that we're seeing from the central banks. Not so much a question, but just an observation that perhaps there was a fair amount of learnings from that may, and how it would have played out in this pandemic had we not gone through what we did a decade or so ago. This next question comes, and it's a question specific to the Canadian markets. Will we see a wave of bankruptcies in certain sectors, such as hospitality and retail, once the Canadian economy emerges from the lockdown?
Yeah, I mean, it's certainly likely that we're going to see some companies not come back. We've taken a pretty hard look at the small business universe, really trying to look at, on the financial side, what's the look like ones that have high levels of liquidity versus ones that have very little liquidity, in terms of cash buffers, et cetera. And really, when you do look at some of the ones that are being most heavily impacted by social distancing, restaurants, those types of things, those are the businesses that really have very narrow margins and don't have a lot of cash buffers. So I don't think it would be terribly surprising if we do see these types of businesses, some of them just not coming back. Now, having said that, we have also seen a lot of these companies, and in the restaurant business in particular, pivot and really trying to use digital strategies to reach households and, being able to order online, being able to get involved with delivery services, et cetera, really just trying to shore up any income they can get during this time when you just cannot have the same capacity. In most cases, you can't have anyone in your restaurant, but even as we reopen, the capacity is going to be much smaller than it was pre-COVID. So I think it is an industry, when we look at even the chart I showed in terms of how their output is likely to be evolving in the second half of this year, those are the industries which are going to continue to be under significant pressure.
Yeah, very, very fair observations. This next question gets to a fair amount of what we've spoken to previously, and I'll paraphrase, but the essence of it is, do we think that the quantitative easing that we're seeing from the central banks is sustainable? And adding with no real liquidity, how it may add to global debt, and then potential impact to taxes in the long run?
Yeah, I mean, I think the central banks doing quantitative easing really aimed at, shoring up the system and ensuring interest rates remain low, sort of as a partner to that. And in terms of the fiscal support, I mean, when we look forward, it is going to be the case that we are going to be living with high levels of deficits and debt as we go through the next several years. So in terms of, what can governments do to generate revenue? Sure, they can raise taxes, but, right now that is not going to happen. Clearly, we need to get our economies not just through the reopening, but migrate that to the recovery and then the rebuilding. So I don't think we're going to see any increases in the immediate term. I mean, certainly over a longer horizon, quite possibly, unless the economy really is able to rejuvenate and rebuild quickly and strongly and see GDP really recover. But so I wouldn't say it's a concern I would have for the near term, but I think over time, it's certainly in Canada, when we look back to times of very, very elevated levels of deficits. In the mid-90s in Canada, the federal debt to GDP ratio was 66-67%, which is staggering. Now, when we entered this economic crisis, it was about 30%. So, it's going to increase to the mid-40s, but we're not back to the unbelievable levels where we really were having a crisis in terms of our fiscal situation in Canada of the mid-90s.
Yeah, that historical context is very helpful. And this next question, I think in some respects builds off some of the previous questions, asking around inflation, expectations, estimates, risk in North America, U.S. and Canada specifically, is what Nate is asking here.
Yeah, I mean, when we're thinking about inflation, we're thinking about economies now that are operating well below their potential and having a great deal of excess capacity. Now, in a very classic economic sense, that says, we're not going to have any pressures whatsoever on inflation. But it doesn't really mean that with the interruption in some supply chains that you might not see certain types of goods that consumers have to purchase on an ongoing basis, see some upward pressure on those prices. When we look at recent reports, I mean, a lot of it has been dominated by energy prices, and they've started to, as I said earlier, start to creep back up to levels still well below where they were last year, but creep higher from the very low levels we saw early in the crisis. So we don't have any significant pickup in our forecast for inflation. In fact, we have inflation rates remaining, relatively low, I would say, through the remainder of 2020, and then, moving back towards, 1.5% as we go through 2021, as some of that spare capacity starts to get eaten up.
Question, you touched quite a bit on the residential real estate market. Any thoughts or observations on the commercial real estate market? And part of the foundation of that question, in my view, is, with offices in New York, we're hearing a lot of talk about companies perhaps not coming back into the office in as strong a way as they have historically, putting 1,000 people in a skyscraper in New York, and that this work from home thing may be here for a little bit longer, perhaps permanently. You see any relationship between that dynamic and the commercial real estate markets?
Well, certainly, it's staggering when you think of it. I mean, we think about February and this idea of everybody working from home. Everyone would have said, no, that's inconceivable. That's never going to happen. And obviously, this is accelerated as something that had been talked about, I think, for a long time. So in terms of people flowing back into the office towers, as you say, is going to take, I think, quite a long period of time. And some people conceivably just will never want to go back and won't. They'll be able to continue on working from their own homes or off-site. So I think there will be implications. It will probably change. We also have to think about the fact that even when we do go back to those towers, it's going to be different. We're going to have more space around us. I think the recent trend has been, hey, let's have everybody in an open concept and really pack people into these offices. So, I think from a demand point of view, we're going to see office spaces that we're going to have a little more elbow room, just because people will want to be a little bit, further apart. So, it's difficult to say it's sort of the end of the office tower by any stretch. I think, it's going to be different, and there probably will be some capacity that won't be filled as we go forward.
Yeah, makes sense. This is specific, this next question. Do you anticipate additional support for the challenged Canadian energy industry?
Well, I mean, I think as we look forward, there's certainly an industry which is important to Canada. And it's an industry that's in transition. We are seeing a lot of pressure for that industry to be moving forward with respect to improving climate outcomes. So, I mean, I think there will be some support in aiding that transition. And of course, we also have a requirement really is to kind of get our product to market. So we also have to see sort of the building of pipelines and getting things going so that we can, in fact, be a viable producer. We've looked at Canada's energy sector in a couple of reports, and it's still a critical industry for Canada. And so to leverage that, we kind of have to really have investment happening, having investment in ways we're going to be able to deliver, the carbon capture, all of that. So, yeah, I mean, I don't know that there will be immediate, new money, but I think as we think about the rebuilding of Canada's economy, it's a definite industry that will have to see investment in it.
Good answer. Helpful. Thank you. Correlations. Is there historical context in terms of how we look at GDP difficult to talk about it at such a macro level because, every industry might be affected a little bit differently when we go through something like this. But is there any historical text that we could, look at some of you regarding GDP in Canada or the U.S. for that matter, and the macro impact on corporate earnings?
I'm sorry, Michael. You were cutting out. I'm sorry. I kind of missed your question.
Hopefully,
I'm sorry about
I apologize. I think we're dealing with the realities of working from home bandwidth sometimes during the middle of the day when I think there's a lot of strain. But it was the question was, is there some historical context when we look at GDP growth, whether it be in the U.S. or Canada, and a macro impact in how we should think about corporate earnings? How tight a correlation is that, and do we have some historic ups and downs in GDP growth or decline inform corporate earnings in a material way?
Okay, so it's asking whether the economic growth correlates with
the macro, just at a macro level. I mean, is there the correlation between corporate earnings and GDP? Is there a tight correlation there, I guess is the question.
Yeah, I mean, certainly when yes, there is a tight correlation there. And when we think about this context, I mean, it is definitely the case that we have had to see companies essentially shut down in many industries during this period because just couldn't, there are obviously essential services which continue to produce and to generate some income. But I think, during this particular pandemic, the degree of decline in economic activity has severely damaged, profitability of companies. So, yeah, I mean, when we look at, if I just review our forecast and I'm looking at the types of numbers, I mean, they're just huge. But again, when we think about what kind of GDP declines we're talking about, I mean, minus 32%, it boggles the mind. So, yes, there is a correlation in terms of those, what's driving the economy and what's driving up profitability of our company.
Thank you. This next question is around the U.S.-China trade dispute, which this questioner suggests is reemerging, and how this may shape or impact the economic recovery.
Well, for a country like Canada, a small, open economy, very reliant, very much more reliant than the United States on trade. The fact that we have seen global trade volumes falter, as you'd expect, of course, during this pandemic, any type of friction on the global scene with respect to trade is always going to be harmful from the Canadian perspective, and especially true, if we start to see price impacts. So, in terms of the geopolitical environment, I think it does present some risk for exports for Canada. A third of GDP, it's a lot for Canada. I think it's more like 12 to 15% for the U.S. in terms of exports as a share of GDP. So not as impactful south of the border, but still, definitely if we see some of this demand deteriorate. Now, for Canada, our biggest trading partner, right next door to us, and assuming that, we do see the type of recovery we're anticipating, we don't see this second wave, that trade will continue to flow. So we do have demand, for our products. And the other thing I would say is, when we're thinking about Canada, we have a relatively small population, of course, compared to many other countries. But we also, demand and security concerns. So food security, for example. So, sort of this idea of buying local, traveling local. We think about tourism for Canada. That is one of our sort of exports, if you will. Canadians as well not going abroad, generating demand within our country as well. So, there's some offsets there, but certainly I think when we think about Canada's economy and its reliance on selling to the world, those are big concerns.
I think this half of the question is somewhat related, specifically back to the U.S.-China trade friction. And do you see that as the impetus perhaps for some manufacturing coming back to North America?
Well, I think, one of the things that this whole episode has highlighted is very integrated supply chains are great, but when you hit a snag like this, when you hit this type of disruption in terms of economic activity, it really does highlight that, in fact, if a country is in crisis and you're relying on them to provide some input into your process, it does has a material impact. So, I don't think it would be surprising to see some degree of reshoring, if you will, on the manufacturing side. I don't think it's going to be, everything is suddenly going to be back in North America in terms of production. But I think you can expect to see, to some degree anyway, some pickup in activity on the manufacturing side.
Yeah, and just thank you, Don. And that I understand there's a huge diversity of questions coming here, and thank you for the very informed thoughts that you're providing back to this. This one's a little outside of my domain, so hopefully I'll get the question right. The question's asking whether or not Canada will revisit the hedging strategy for its oil reserves because COVID-19 taught us that the current strategy isn't sustainable for shocks like these.
I'm not exactly sure either, I'm afraid to say on that answer. I think
that's a very fair response. It's asking a lot of you to switch gears like we are from commercial real estate to oil reserves. But I think the audience is really appreciating your efforts to answer all of them.
Yeah, well, I think when we think about, Canada from the oil perspective, just going back to the idea that, for Canada, one of our biggest challenges is getting, our product to market. And that has been a problem for a sustained period of time. And during the current crisis, it really is this demand destruction. That, just shocking, right? Planes aren't flying, so jet fuel's not needed. People aren't driving their cars. Now, as we reemerge, some of that demand definitely is coming back. So I think from the perspective of, Canada and our industry, we would expect to see some improvement. We look at rig counts, though, in both Canada and the United States, and they are down significantly because of this crisis. So, production has had to be dialed back simply because the demand evaporated, essentially.
Yeah. This next question, I think, is a double click on something that you were alluding to when we were talking about U.S. and China relations in asking about the deglobalization of supply chains. Do you anticipate that some of what we've experienced over the last couple 3 months will lead, I guess, to a harder look at the dependent global supply chains?
I think to some extent, yes. I guess the one thing too, though, is to do that, it will necessitate higher costs. So are consumers going to have the appetite to pay more to have something that's made in Canada, made in the United States? Certainly there will be some appetite for that, but I don't think it's going to be the dismantling of all of these international supply chains. I think, to some degree, we will see in some instances some pulling back or onshoring, but I don't know if we can really say it's the death of international supply chains at this stage.
This next question, again, is pertaining to the Canadian energy markets and gets rather specific. It's asking RBC's thinking of minimum oil price for Canada oil sands industry. And I think there's a couple of very specific acronyms that I'm not immediately familiar with, but perhaps you are, in terms of WCS price or WTI/Brent price. Does that mean
What the
anything?
break-evens? Yeah, so West Texas Intermediate and Western Canadian Select prices. So in terms of the break-evens, I have to tell you, I haven't seen them recently. But if you, I'm happy to get back to that questioner and get them, because I wouldn't want to mislead in terms of what those break-even prices are at this time, because I haven't seen them in a while. So if you forward that question, I will get back to them
for sure
with those numbers.
Yep. This is a follow-up to an earlier question from one of our video watchers. If rates rise in the U.S. interest on debt could exceed the defense budget, as an economist, what will this mean to the U.S. economy?
I'm sorry. Can you just?
Yeah, I'm going to try and reread that. Yeah, it was if rates rise on the U.S. Interest on the debt could, I think it's an observation, exceed the defense budget. As an economist, what do you think the impact on the U.S. economy would be?
Well, yeah, I mean, paying interest on your debt to service your debt is probably not the best use of taxpayers' money, I always like to say. Having said that, I think at this stage, this is a necessary thing to get our economies through something, our population through something that is, beyond our control. So, if interest rates do rise and they do create significant upward pressure, but when we think about it, the debt that is being issued now are at extraordinarily low levels. And as I said in the presentation, we don't anticipate any significant upward movement in interest rates over the next couple of years. So, to that end, I would say, yes, in the future, certainly if we start to see interest rates really rise. But again, I'm kind of hard pressed on that one to say that I think we're going to go back to the 4 or 5% interest rates anytime in the next decade.
Yeah. This next question is, again, building off of some of the previous questions around impact that the oil prices are having on the Canadian economy. This is specific to Alberta. This watcher is asking, how essentially is Alberta expected to survive in light of the low crude oil price?
Oh, yeah. I mean, certainly when we think about the provincial outlook and we think about how individual provinces are going to perform, Alberta is going to be very, very, Alberta, Newfoundland and Labrador and Saskatchewan are sort of at the bottom of the rankings in terms of economic performance. Huge decline. So if, we're having a 5.9% decline, or around 6% decline at the national level, we're looking at, 8 to 9% declines in these provinces. So that obviously, blows out all other declines we've seen in terms of recessionary conditions. And we do think for Alberta, it is going to be a tough slog. It's going to be a very long period where, because we're not going to see a lot of investment dollars flowing, it is going to restrain how quickly they are able to come back. So we do have their economy, really lagging and in terms of other economies as we go through 2020 and 2021. It's hard to say all these 20s. And so when it looks at, for example, our forecast, it's going to be a loss of about 8% by the end of the year level of GDP compared to February. So it is going to be a very strenuous period. So even with the decline, the huge decline, we still have a relatively modest recovery as we go through 2021, and the unemployment rate in the province, will remain high compared to what we were used to during the days of very high oil prices.
Very helpful. I've got a couple things that have come in, one of which is addressing the question around the Canadian break-even price, and it's identified here. And thanks to Ensworth Rose, it said 41 USD. So is the break-even price that was, I think you were going to go back and research. So may save you a minute to do that. The other question, somewhat from someone was asking for Eric's last name. Eric's last name is Foo, F-O-O, and we can make sure that when we send out when we send out the recording that we can give you Eric's contact information in that. I think we've still got another question or two. Nope, it looks just really a lot of thanks, Don. People are very appreciative of your answers and your willingness to respond to a wide range of questions and interests from the group. It's been great having you with us. What I'll do is just follow up then with a little bit of detail regarding our next in this series, which will take place next Friday. We will have Will Robson, senior economist at MSCI Real Estate, and he'll be looking at COVID-19 in the global real estate market. So I think that was a question that came in asking around commercial real estate. For those that have that in, should allow them to take a closer look at what MSCI is expecting on that front. So please join us. Please make sure to complete the survey before you leave today. Give us your feedback. And I guess I'll wrap it up, Don, with a final thanks for all that went into your presentation and the very thoughtful responses to the questions that we had today.
Oh, pleasure. Thanks for having me on.
Thanks, everybody. Appreciate it.